Hey guys, welcome back to the Modern Capitalist. In this series titled the Quantifying Finance series, we are going to basically explore seemingly complex kind of financial topics and try to use logic and rational kind of problem solving analysis to basically demystify these seemingly complex topics, right? First, kind of thing to analyze on the list is kind of this discrepancy, right? This kind of myth, this disparity between day trading and value investing, right? Or like any other type of investment strategy, right? In one side, you have, how many times have you heard value investors say, oh, like trading is like, I'm not a trader, I'm an investor, right? As if they're like the investors are looking down on traders, right? On the other side, you hear traders like, look down upon investors, right? Oh, these guys are like old, boring, the returns are like so bad, right? But at the end of the day, both camps of people are simply arguing over semantics. Because when it comes to any type of trading, any type of investment strategy, whether even if it be poker, right? Every one of these kind of different strategies is ultimately at the mathematical level, one and the same. And what any type of investment strategy is you are simply making a bet when the odds are in your favor or when you think the odds are in your favor, right? Now, different strategies may have different criteria for determining when the odds are in your favor, right? Value investors may analyze the company's fundamentals and their balance sheets. Traders may analyze the technical analysis chart patterns, right? But at the end of the day, there's the kind of same mathematical foundation that governs all type of trading investing, right? The financial markets as a whole is nothing more than the world's largest casino, right? Investing and trading, it just you're just simply making bets, right? And so, with that said, you can approach the game as 95% of people who enter the casino do. It's like almost as a form of like entertainment, right? Or you could approach the game as the rare kind of like 1 to 5% of people do, right? The card counters, the ones who have kind of like a system, a betting system based on, statistics, mathematics, etc., right? And you need to be in that kind of latter camp of people in order to consistently achieve, oversized returns, right, relative to the market. And so in this video, we are going to go over what I call the golden equation, which is the expected value equation, the equation that underlines all investment and trading strategies. The expected value formula, or EV, right? Every single kind of strategy system boils down to this. And what this equation is, it first takes in four variables, right? The percent win, percent loss, average win rate, and the average loss rate. Now, what this means is that the average win rate and the average loss rate, both add up to 100%, right? Let's say on average, you win, example, 60% of the time, which means you're losing, example being 40% of the time, right? Average win, average loss. How much money are you winning per round or per bet? And how much money are you losing when you lose, right? And let's say every time you win $2, or this could be 2%. Every time you lose, you could be losing $1, right? It's not necessarily the absolute amount. It could be $2, $1, $2,000, $1. It's the ratio that's important, as you'll see. So the formula here of expected value is, sorry, average win rate multiplied by the percent win subtracted by the average loss rate multiplied by the percent loss, right? So I think that this marker may be too thick, so I'm gonna try something. So EV, expected value. It's very simple. If your EV is positive, it means you are profitable as a trader and or an investor. If this is negative, it means you're bleeding money. Simple, right? So let's kind of take a couple of examples from the real world, right? This is what kind of we call, or what I call, the golden formula of all trading investing. So let's take, for example, Warren Buffett, right? We all know he makes a crap ton of money. He's been doing it for like decades and decades and decades. So what is Warren Buffett's kind of formula look like, right? His win rates, obviously these are just examples, right? I don't know his exact kind of statistics. I know my exact statistics, which we can discuss later. But let's just say, on average, he wins, let's say, 85% of the time, right? Which is very good, right? And which means what? He loses 15% of the time, right? How much money does he win per investment? And how much money does he lose when he loses, right? These are just, again, examples, right? Let's say every time he makes a successful investment, he makes $3. Every time he loses on an investment, he loses $1, right? Obviously, this is like 3 billion in real world use case. It's like 3 billion to a billion, whatever. But what's important is the ratio, right? And so clearly, his expected value is positive, right? And that's why he's been able to compound his money over the decades, right? Let's take the example of a high frequency trader. These are like, the Wall Street algorithms that trade like, I don't know, like 50,000 times in and out a day, right? What are the statistics of that kind of investment or trading strategy, right? I use trading investment synonymously. The HFT may only be winning 51% of the time, right? And every time he wins, he may only be winning $1. So this is a subtract, which means he's losing 49% of the time. And let's say every time he loses $1, right? So it's a one-to-one risk-reward ratio. And so clearly you can see that this is positive, but the statistics as it stands now, clearly Warren Buffett has the higher expected value, right? But what kind of people don't mention is that there's this kind of fifth variable, included in this formula. And the fifth variable is the frequency of occurrence, which means how many opportunities are there to place this bet within a certain period of time, let's say 1 year, right? Warren Buffett only makes, let's say 2 to 3, let's say 3 investments per year, right? The HFT may make millions of trades a year. And so even though Warren Buffett's kind of this part inside the parentheses has superior statistics, if you factor in the kind of frequency and the opportunities per year that he gets, the HFT may get higher returns on a percentage basis than Warren Buffett, right? But it doesn't matter, these two people have various like extremely different kind of criteria for placing a bet. But at the end of the day, all of these different strategies fall under the same formula. So what's important is that whatever strategies that you trade, whether it be day trading or value investing, you have this formula in the back of the mind so that, you're not going into the casino just for entertainment purposes, right? You actually become the guy who's counting cards, who's able to basically beat the house on a continuous basis, right? Again, let's use another example. Real estate investment, right? Also applies. Real estate, people think it's less risky because, let's say they can win. I think if you're experienced in real estate, you can probably win 80 and 90% of the time. And I'll explain why that is, right? Maybe 90% of the time you are winning, right? And every time you win, you're winning $2. Every time you lose, you're losing $1, right? So the risk reward ratio is still optimal. And so what is the problem with real estate, right? The problem with real estate is that it's not scalable relative to, for example, stocks or HFTs, right? And why is the reason? Why is that? It's because if you're, let's say, selling real estate, flipping real estate, investing real estate, right? There's so much kind of human involvement, right? You got to go to a broker, you got to go to an agent, you got to find contractors to fix up a house. And so that's all of that can be quantified in a single variable, which is a frequency. And so the problem with real estate is that the frequency is so low because you can't scale it. So maximum, let's say you can only like invest in 5 or 6 houses a year, right? The EV may be positive, but it's not scalable beyond 5 houses a year, which is a weakness, right? The kind of perfect investment strategy or trading strategy, this is like perfection, right? Would be a strategy with like a massive win rate, right? And a super awesome, risk reward ratio of like 5 to 1, right? And it has like a million kind of frequent opportunities per year, right? And so this is like perfection. So, but the problem is that if something like this exists, it would be quickly gamed out of existence. And so it's the trick and kind of the skill when it comes to investing is kind of optimizing for these various variables, right? Sometimes you may want to sacrifice your win rate in order to optimize the risk reward ratio. Maybe you want to optimize this kind of inside of these kind of parameters or these parentheses, kind of like increase your kind of criteria so you make smaller number of kind of bets, but these bets have a higher win rate and a higher risk reward ratio, right? And so it's all about fine tuning your strategies, right? Now, for me personally, my kind of cash flow kind of business is day trading, right? The me, right? The common kind of misconception is that, day trading is, how many times have you heard this, right? Day trading is extremely risky, right? But if you kind of take a first principles approach and view it in the same lens as all these other different strategies, you'll see that, like I said, like I mentioned earlier, mathematically, it's all the same. So these are my statistics, right? I win about 67% of the time, right? When I win about $2. I lose 1 out of 3 times. And when I lose about $1. So I have a risk reward ratio of about 2 and a win rate of about 67%, which is 2 out of 3. And my frequency per year, I would say, is about 500 trades, right? And so my EV is positive, right? Similar to how every single one of these strategies EV is positive. Now, obviously, when you actually calculate this, you gotta, factor in, the cost of executing these bets, right? Commissions, etc., right? But for the simplicity of these demonstration purposes, we're just going to assume that commissions and fees are included in these numbers, right? And so It's like this common misconception that value investing is safer and day trading is riskier is from a mathematical perspective is actually false, right? The reason why day trading is quote unquote risky, it's not necessarily risky, it's just harder because the time frame of your bets are condensed, and therefore all of the emotion is condensed. Example being, let's say you are a value investor and you invest in like Apple or something, right? Let's say your investment doesn't go according to plan and you're facing a loss, right? Losing $50,000 over the course of a few years in a value investment type of bet, compare that to losing $50,000 within a couple minutes in day trading. Mathematically, it's the same, but emotionally, the pain and the loss aversion is much more compressed in day trading because the time frames are shorter, right? And that's why most people find it difficult to day trade because emotionally they're not wired to tolerate the pain, right? But I mean, fortunately, this kind of pain tolerance can be developed over time, right? Systematically, similar to how you go to the gym and you like lift weights, right? Progressively overload your body in the gym and progressively overload your pain tolerance psychologically for these losses, so that you can scale up your trading, right? The other kind of reason why people fail or struggle in trading, short-term trading, and even are unable to beat the general market returns, is because they fail to think in terms of kind of statistics and large sample sets, right? The human mind is very difficult to think in terms of sample sets of, let's say, like large numbers, right? 50, 100, whatever. Most people can only think in the terms of like here and now, right? This specific instance. So I'll give you an example, right? Most people can only think in terms of a single outcome. So this is the statistics of a newbie that comes into trading, right? He wins. Let's say he wins 99% of the time. Every time he wins $1. He only loses 1% of the time, but every time he loses $200. So, and the frequency doesn't even matter because this part is negative. Do you know what I'm saying? So psychologically, it's much more comfortable to book gains, right? Book profits. That's why it's like it's only in your human nature to like try to make like a little money here and there, here and there, here and there, right? But the problem is when you do take that like rare occurrence of a loss, it wipes out all of your gains, which makes your entire system negative. So you're bleeding money, right? Colloquially, we call this type of like these type of statistics or these type of numbers picking up pennies in front of a steamroller. And so, you're picking up pennies, or you're making $1 here and there. But when you lose, you're literally getting steamrolled. And how many times, for example, have you heard this, right? I mean, as long as I hold long enough, right, the stock will recover, right? It'll always come back up, right? That may be true 95, 99% of the time. But if you keep adding to your position, if you keep buying more as the stock goes down, the one time that it doesn't recover, it will wipe out everything, right? And so the key to successful trading and successful investing is being able to think in terms of statistics and large sample sets, understanding this golden equation, the average win rate, right? On average, I win 70% of the time, right? When I win $2, right? On average, I lose 30% of the time. When I lose $1. So my risk reward ratio is 2 to 1, and I win 70% of the time. And on average, I have 500 opportunities a year, right? Understanding this equation is the first step to mastering any type of investment strategy, right? Crypto, real estate, value investing, stock trading, right? Everything boils down to this one equation. So, hope you guys learned something, and we will continue this series in another video. So, take care.